I'm very pleased to introduce to you our latest team member in MAM, who is Matthew Piepenburg, or in American English it would be Piepenburg. I've known Matt for a while, and we discussed early this year, because Matt has a very interesting background, that he would join our team. He would be the perfect complement to our team. Matt's background is he's been to good schools, Brown's University, law school, Harvard, where he got top marks. And then he has a very interesting career behind him. He managed family offices. He has managed a hedge fund and also invested very successfully into a hedge fund. He's written a book called Rigged to Fail, which has done well on Amazon. So he's got an excellent background for us. But what is especially interesting, Matt, is with that background, and you've managed complex investments in stocks and bonds. But how come that you actually started to become interested in gold with that background?
Yeah, you guys, it's kind of a natural evolution. And they say it kind of takes a fox to know how to catch a fox, or it takes one to know one. I mean, I started off with hedge funds of my own, and then I began investing in them. And of course, when you're dealing with hedge funds, you're dealing primarily with risk assets like stocks and bonds, regardless of the strategy, whether it's arbitrage or some hedging strategy. Ultimately, you're dealing with credit markets and equity markets. And so in the 25 years of my evolution from my first kind of hedge fund to investing in hedge funds and to investing other people's money or families' money in hedge funds, it gave me an extraordinary opportunity to talk with some of the best portfolio managers in the world. And also, the years teach things the days don't notice, and you start to get your arms and eyes and mind around stocks, bonds, and other risk assets. And over that 25 years, it's been an interesting evolution to watch the asymmetry in the risk and the reward in both stocks and bonds. And you find yourself scratching your head and saying, what do I do with this risk? And that's kind of how I naturally came to precious metals. With stocks, it was very simple. Over the years, since the dot-com bubble and post-2008 crisis, I just saw an immense exaggeration in PE ratios. I saw tricks that accountants use with X items accounting to doctor balance sheets. I saw the Fed suppressing interest rates significantly to allow companies to borrow extensively, add a massive amount of debt to their balance sheets, use that money to buy back their own shares or to issue dividends, to give a false confidence and really eliminate good price discovery in the stock market. In the bond market,
so can I just ask you, so did you actually find that risk became unacceptable in stocks and bond markets?
In both cases, yeah. It became unacceptable. It became difficult to measure using the traditional tools. With stocks, the cyclically adjusted PE ratios or just basic PE ratios became difficult to trust. Stock buybacks distorted really what was the real earnings of a company. In the bond market, you've seen so much support since the 80s in general, but particularly since 2008 when the central bank came in. You saw so much distortion, artificial support of the bond market, at such levels, both in Europe and the US, that prices were pushed up so artificially high that yields became negative, and when adjusted for inflation, highly negative. So you just saw a massively inflated bond market, a massively distorted stock market. And then, of course, all of that floats back to the central banks, which have began as an emergency measure in 2008, a short-term solution, which now has become an addiction 12 years later. We're now effectively, I call it a Fed market, not a stock market. And the bond market's so distorted that we have negative yields around the world. And of course, with central banks like the Fed or the ECB printing trillions of dollars, it's important to think about that. I mean, I read the other day that $1 trillion is a big number. It's become an abstraction. But if you were to try and spend $1 trillion at $1 a minute, it would take you 34,000 years. So $1 trillion actually matters. The Fed's balance sheet pre-08 was $800 billion. By post-2009 to 2014, it had gone to 4.2 trillion. Today, we're looking at the Fed getting to 6, 7, 8 trillion in emergency measures. Those trillions and trillions of dollars have consequences. And ultimately, in addition to distorting price discovery in the bond and stock market, you've obviously diluted the purchasing power of your currency. For me, whether you make $1 million, 10 million, or 100 million, at some point, the millions you have purchase less and less because of the central bank's distortion of the overall markets. And so currency risk was the obvious concern for me. Precious metals in particular became an obvious selection for me to insure against the obvious risks in purchasing power. And I know, Egon, that since you and I met informally and then formally, I've often talked about currency risk. You've often talked about banking risk. You've been talking about banking risk for years. I'd like to ask you, in the many years since you founded Matterhorn, how has your view of banking risk in the markets evolved in the many years you've been talking about it, especially now?
Well, you know, when we formed Matterhorn, which was over 20 years ago, and we went into gold heavily 18 years ago, you know, my primary consideration was not banking or currency risk at the time, although I know it's totally linked to it. But it was actually the financial risk and systemic risk. Because already in the 90s, I saw how derivatives were building up, how debt was building up. And it was really as a protection against a rotten financial system that we said to our investors that we advised at the time. It was a private company then, a small private company. And we said that, you know, now we think it's the time to protect yourself heavily against the systemic risk, and the risk is in the banking system. So this is really why we were not gold bugs at the time. We were in no way in love with gold as a solution to all problems. Gold was just the consequence of our risk analysis. We felt that risk was excessive in the system. Remember, this was 2002 and nobody saw risk because, as you know, we've had the dot-com bubble that collapsed. NASDAQ had just fallen by basically 80% by 2002. But anyway, we thought that this is the time now to buy gold. It was still unloved and undervalued, very cheap, $300. So we went into gold. Then, of course, simultaneously, as you say, gold is also protection against debasing currencies, because the consequence of the constant money printing that you mentioned and that has totally gone exponential in the last few years. The consequence of that is that the currencies continuously are being debased, and you know, only in this century, i.e. since 2000, currencies are down on average 80–85% against gold, and that means that currencies have lost in real purchasing power terms 80–85%. So to me, it was such a simple solution to take gold as the best protection against your risks in the financial system, your systemic risk, as well as, of course, the total destruction of paper money. And it is the only, I know of no other asset that fulfills all these criteria, certainly not in current time. Sure, at times when stock markets or bond markets are extremely undervalued and unloved, like gold was when we bought it, that's another matter. Then you can buy stocks or bonds. But right now, these assets represent massive risk, and we certainly wouldn't recommend them today. But you know, gold also protects against inflation. Everybody talks about gold against inflation, and I think we have a high risk of hyperinflation in the world. But what few people understand is that gold is also very good protection against deflation. And how do you see these risks between and really the purpose of gold in relation to inflation and deflation, Matt?
Yeah, it's another really important question. Everyone's talking about this deflation versus inflation debate, or is inflation been outlawed by the central banks? Will we ever see it again? And so we've gone decades without at least reported inflation. I think these questions we get all the time, I think in some ways are the wrong question. It's not deflation versus inflation. It's deflation and inflation. They're not an either or zero-sum discussion. It's ultimately a cycle, not a competition. Deflation, of course, has been around for decades for a number of reasons. Inflation is also coming for a number of reasons. By the way, it's important to note that even with inflation in the US below 2% for many, many years, gold's continued its cyclical rise, even in a deflationary environment. But I think this debate between deflation and inflation is more academic. The cycle is typically deflation first, inflation second. A lot of the reasons inflation has been muted, I think one reason is very simple. The scale used to measure inflation, both in the US and elsewhere, is a disingenuous scale. That's not fake news or conspiracy theory tinfoil hats. The simple fact is the pre-Greenspan measure inflation, the scale we used under Volcker and others, would actually place inflation today at closer to 8 to 10% in the US, and inflation would be higher than reported in Europe as well. There's an intentional reason to misreport, I think disingenuously to misreport inflation, because if you had 8 to 10% inflation, the real return on your bonds, your government bonds, et cetera, would be even worse than they are today. Right now, the 10 years at less than 1%. Last week, it was at 0.69. But ultimately, I think we do actually have real inflation. Secondly, there's a lot of talk about Eurodollars or the repo markets absorbing these costs, or that the central banks, whether it's in the US or Europe or Asia, can print money to buy their own debt, monetize their own debt, and that money stays in a nice tight loop. It never leaks into the real economy, so we never have velocity, we never have inflation. So inflation's outlawed. That's the big talk of modern monetary theory. I think that's absolute fantasy. You simply can't print trillions and trillions and trillions of dollars without eventually having an inflationary effect. But again, the scale used to measure inflation is somewhat broken and disingenuous. Secondly, I think inflation will come because the central banks are no longer lenders. Now they're spenders. You see this in Europe, you saw it in Japan. You're now seeing it this year in the US, where the Fed is literally using printed dollars to support commercial mortgage-backed securities, junk bonds, other credit instruments. The Fed is now buying ETFs. That money slowly leaks into the real economy. That creates velocity. Already core inflation is starting to pick up in the US. So inflation, when it comes and how it comes, is academic. It will come. You can't outlaw it. When inflation goes up, interest rates go up. When interest rates go up, the cost of debt goes up. All the companies on the US markets and elsewhere who rely on debt rollovers and low interest rates are about to get the shock of their lives. So that will certainly affect.
I agree. But Matt, we have an interesting situation, because as I see it, and I don't know if you agree with this, we will have inflation, and I think hyperinflation due to currency debasement, as you discussed, and the interest rates going up. But and we've seen it time and time again in the Weimar Republic, in Venezuela, in Zimbabwe, etc., many places around the world. But at the same time, as we have in certain assets, especially commodities, food, services, will have high inflation because of the currency collapsing. At the same time, these bubble assets, as I see it, will deflate. I mean, the stock market and the bond market will totally deflate. So in some way, we have inflation and deflation at the same time. But as consumers will see it, it will be mainly inflation, because normal consumers are not worried about the stock market. They're worried more about the prices in the street.
No, it's true. It's fascinating. These bankers talk about how inflation's been outlawed, not to worry. And look at the stock market since the money printing began in 2009 in earnest. I mean, you've seen inflation go right from the Fed and the Treasury directly into risk assets, which explains a 300-400% move in the S&P. That inflation is extraordinary. When that pops, the cycle goes down in the markets, and then the cycle of inflation for the average American, average European, average citizen of the world is going to start seeing real inflation at their house. But the other thing about banks that fascinates me, going back to this conversation about currency risk and inflation, for many, many years, the banks that I'm familiar with or traded with or worked with, like Goldman Sachs, have been kind of poo-pooing gold or downplaying gold as an asset for their portfolios. For someone who's been talking about gold for decades, Egon, how do you explain this reticence of banks like Goldman and other big, family name office banks? How do you explain their reluctance to really get behind gold? And now the headlines are pushing gold. Everyone's talking about it. Why are banks still dragging their heels a little bit on this?
Well, first of all, when we talk about banks in general, Goldman, I mean, they have many tongues or many heads. So when one part of Goldman says that, we don't believe in gold, like the chief investment officer of their client, high net worth clients, said the other day, on the other hand, maybe the trading department of Goldman is long gold. But generally, especially asset management banks hate gold for the simple reason that they can't make any money out of gold. That's why, they can't churn commissions, and they can't, open a fund in physical gold where they earn a 5% upfront, like they're used to with their own products, etc. So therefore, first of all, they don't understand gold, because there's been an era now for 40, 50 years when stock markets have been so easy to invest in and make money. And if you bought and held for any period in the last 50 plus years, even 75 years, you would have made a lot of money, and you would have sat through all the corrections and you made money. So therefore, it's investing have been such an easy game. You didn't have to think at all. You just bought and held, and then you made money. Whilst in gold, it's been a much tougher market, and as I said, they make no commission. So that will change now. Banks will have to recommend gold to the clients, because they're going to ask for gold, because they see with gold price going up. So they will buy gold and gold stocks. And of course, institutions will buy gold because they need to inflation protect their portfolios. And other funds also will do that. So we're going to see a major change in the way that gold is looked at and treated. Now, most of them will want still to do it in the form of financial products where they can earn money. We believe more in the physical outside the banking system, as you know. So there's a difference. So this story is going to go on for, and this is why we really started talking, Matt. It's going to go on for years, 5 years, 10 years, longer. The gold story and the protection of your assets and the inflation protection. It's going to go on for a long, long time. It'll be a total review of the way people look at gold. So this is why we're going to have so many interesting talks in coming weeks and months and years, Matt. And I mean, this was our first attempt at having a discussion together with you, because since you recently joined us this year, but hopefully we'll have many more interesting discussions. And this is more of a general introductory one, but we'll have more. So I will enjoy speaking to you, Matt, and we will. There'll be so much interesting stuff to discuss, won't there?
Absolutely, great. It was good talking with you again, as always. We'll talk soon.
All right, Matt. So all the best, and we'll talk soon again. I mean, the reason why we are separated is, of course, that coronavirus makes it harder to meet in offices, etc. But we do meet also, but we're also separated part of the time. All right. Thanks for everyone. Thanks, Matt, and we'll see you soon again.
Okay, Egon. Take care.